Welcome back. Let me invite Prateek Parekh, the equity strategist at the Nuvama Group, to discuss the markets the way ahead. Prateek, morning. I want to take off from what Mahesh Nandurkar had to say in his note yesterday. Fiscal pressures are building with oil prices rising. Expenditures in an election year would be difficult to trim. Slowing nominal GDP and rising oil prices may restrict tax revenue surprise. So do you want to first quickly lay out the macro picture up until now in terms of, the key indicators, how the tax revenue buoyancy has been, what the expenditure is, and how it compares historically?
Yeah. Thanks, Rima, for having me over. Today, if you look at, Indian macros, they are, at a fork road of sorts per se. I mean, it's very different from what it was 3 to 6 months back. First, with regard to macro vulnerabilities, what we are seeing on the external front with oil prices rising owing to a supply shock, as well as higher interest rates globally, they do not augur necessarily well for India's overall environment. I mean, today, mind you, India's trade deficit is still elevated at $25 billion a month. And more worrying part, I think, is the FDI flows, where if you look at on a rolling 12-month basis, the FDI flows are at just $20 billion annually, which is on a moderate level. So in such a scenario, the rising oil prices and higher interest rates globally do not really help the situation. But on the growth front, where India has done very well so far, I think has been into two main pockets, I would say. One pocket where it is doing still very well is the high-end consumption. Whether you look at luxury real estate sales, whether you look at SUV sales, they're all doing very well. And the second pocket where growth is still holding up is the infrastructure slash capex related stuff. Here, this to an extent is dependent on government finances. This government capex has been running very strong, 25% plus over the last 12 to 18 months, which is very encouraging and has helped propel growth higher. But from here on, we do see risk on sustenance. As you clearly mentioned, that tax revenue growth has slowed down very meaningfully. If you look at on a trend basis, the tax revenue growth is now in single digits. And with rising oil prices, corporate margins also will come under pressure and will further add to tax revenue concerns. So to that extent, going ahead, we could see some pruning on the capex front. And as a result, in the near term, the growth outlook isn't really particularly, encouraging because you're having exports which are very weak. The rural economy, will see some pain points going to erratic monsoons. And on the other hand, on the domestic part, if government capex to slow down, then one more engine, weakens of sorts per se. So in the near term, we do see concern on the growth and the macros part per se, Rima.
Prateek, you want to give us some numbers on the tax revenue? What does it currently stand at? You said it's slowed to single digits, but what are the growth numbers and how would it compare with, say, same time last year? And also, then as a follow-up, you believe the slowing tax revenues will start impacting or force the government maybe to go slow on its capex. What's been the capex growth up until now? And again, if you could compare it with, say, the previous years.
Yeah. So if you look at the tax revenue growth, I mean, looking at a monthly basis, very volatile. The way we look at it is on a rolling 12-month moving average basis. On that basis, this growth is at 7%, which is at a post-COVID low. If you look at the previous time when we hit 6-7%, was just prior to COVID in 18-19. At that time as well, if you recall, the overall economy was kind of slowing down, and there were limited fiscal levers available at that time as well. But one variable which hurt tax revenue very meaningful at that time was corporate tax cut. Today, we are already at a very low levels, and to that extent, it is clearly a worrying sign. Second, with regard to government capex, here as well, as I said, we are growing at 25% plus on a 12-month moving average basis. And going ahead, with oil prices being elevated, while capex may not be necessarily have to be too much because your subsidy bill also on the moderate side. But nonetheless, we are seeing some fiscal strains coming through. How much and how it eventually play out, we get to know only, going ahead. But nonetheless, there are certainly risks to the capex momentum that we have seen sustaining for the rest of the year per se.
Okay, got that, Prateek. But considering that we're, in this kind of macro setup now, and you're saying these risks could persist for the near to medium term, What would you advise an investor to do if someone is to get into the market now? Are there pockets that you feel are better positioned? Would you say that perhaps you should have higher cash positions now and not get all in?
Yeah. So definitely, in current scenario, it is not a very great sign from a near term or from a 6 to 12 month return perspective. I mean, today you have macro, at the margin deteriorating. You have growth concerns, kind of rising, and more importantly, valuations are quite stretched. I mean, today if you look at the aggregate Nifty PE, it is not very much out of whack with historical range. It is around 19, 19.5 times. You could say it's 10% higher than last 5-year average, probably 15% higher than last 10-year average. But what is very worrying is the aggregate of broader level market valuations. I mean, today the median BSE 500 PE is around 35, which is very high compared to historical standards. In such a scenario, clearly some caution is warranted. We do advise having higher cash levels, and if you want to remain invested in market, one should follow perhaps a two-pronged strategy. One should look into buying companies or sectors which are cash rich in nature but are currently going through a lull phase, which perhaps lies in the mass market consumption areas. But it is within them companies which are having some micro triggers of sorts per se. And second is those companies which have consistently delivered very good growth, and where we still see that momentum continuing, either because of companies' excellent execution track record or that industry being in the right space at right time per se. What I would argue.
Prateek, you want to name some companies, the cash-rich ones, but are going through a bit of a lull in their growth phase? Which are the stocks that Nuvama is recommending now?
Yeah. So I'll avoid the company recommendation and I'll stick to the sectoral part. But the companies or sectors that fall in that category are something like two-wheeler space. Some of the consumer durable companies fit that bill. Some of the QSR companies. These are the sectors or space where we think that these are cash rich and to a reasonable extent, downturn risk are priced in. And similarly, the IT space in general. If you look at the large cap IT, your growth concerns are now very much factored in. I mean, growth is going to remain weak as consensus. It is seen in consensus estimates, which are forecasting only 7-8% top line growth. Margins are at almost bottom levels, and with dividend yield of around 4 to 5%, there is automatic downside protection. So these are the areas, Rima, that we would look to where we find some comfort of sorts. But we would definitely, avoid some of the expensive cyclicals at the current juncture, especially with growth concerns being around the corner per se.
Okay, Prateek, just one final question before we let you go. What is your call on this PSU Bank rally that we've seen? I mean, 16% this month so far. The question is, does this rally have legs? Is there more to go over here? And would you recommend some of these stocks?
Yeah, so I think PSU banks have clearly done very well. And I think this is just natural outcome of the environment. Today's environment is domestically is of a benign liquidity condition as well as what you call credit growth holding on. In that, those PSU bank stocks which are below book have re-rated, and some of it is honestly warranted as well. But from here on, I would be a little bit more careful over here because the low-hanging fruits to a reasonable extent are plucked. And more worrying is that we do foresee growth concerns. In such a scenario, PSU banks by design are a higher beta, to the overall industry dynamics because of their higher or lower tier 1 ratios or higher leverage levels involved over there. And in such a scenario, if you do get liquidity shocks, these banks will be by design more vulnerable than some of the large private sector banks. And also today, it's not like the valuation gap between PSU banks and the large private sector banks is very large. HDFC Bank is there at 2.2, 2.5 times. Similarly, the ICICI Access. And if you look at the PSU banks after the rally, there are very few of them which are still below book. So a lot of normalization in valuation and earnings is done. This can certainly have more legs if credit growth remains buoyant in mid to high teens and liquidity remains ample. But as of now, we don't foresee such a scenario, given the external headwinds and even on the domestic front, with potential slowdown in the mass market areas as well as government capex, credit growth will have more of a downward bias they are necessarily upward bias per se.
Prateek, thank you very much for joining in. Lovely conversation. We'll slip into a break. We'll come back and get you a snapshot of the credit card performance of July 2023 as a part of our special segment, FinStream. Stay tuned.